Have you ever wondered how banks make money? To understand this, you need to first understand the circumstances that lead to creating a banking system. Back in the day, people didn't have money as we know it today. Instead, they used the barter system, exchanging goods and services directly. A farmer might trade wheat for a blacksmith's tools, or a potter might swap clay pots for fresh meat. It worked, but it had its challenges. Imagine trying to trade 100 cows for a house. Not exactly convenient, right? To make trade easier, people started using gold, silver, and other shiny metals as money. Can you imagine how cool it was when coins came into play? Suddenly, transactions became a breeze. No more hauling heavy wagon loads of goods, just toss a pouch of coins in your pocket and you are good to go. But here's the catch. With all that shiny treasure came the risk of theft. Traveling with a bunch of precious coins was like waving a big red flag for thieves. Just think about it, one wrong turn and you could lose everything. So, while coins made life easier, they also added a whole new layer of danger to the mix. However, it was a game changer for sure. There enters the Goldsmiths, the world's first bankers. People started bringing in their shiny gold coins for safekeeping for a small fee. In return, they got a little receipt that proved they owned the gold. Super handy, right? These receipts were way easier to carry around than heavy coins, and soon enough, they became a hot commodity themselves. Then came the big game-changer realization that transformed banking forever. Goldsmiths, who were initially just safekeepers of gold, noticed an interesting pattern. Most people didn't come back to withdraw their gold all at once. Instead, they preferred to keep it deposited and use the receipts for trade. This sparked a brilliant idea. Since the gold was just sitting there, the goldsmiths figured they could lend some of it out to others and need at a profit. They started giving out loans in gold and charged interest on the borrowed amount, but they didn't stop there. Instead of only lending out the gold they physically had, they realized they could issue more receipts than the actual gold in their vaults. Because after all, people were mostly using the receipts for trade rather than withdrawing their gold. This meant goldsmiths were now creating more virtual money than what physically existed. This system allowed them to generate even more income, as they were essentially multiplying their money supply without needing extra gold. And just like that, the foundation of modern banking was born, that we know as fractional reserve banking. From simply storing wealth, goldsmiths had now evolved into financial institutions, fueling economic growth, funding businesses, and shaping the global economy. What started as a way to keep gold safe turned into a powerful system of lending and money creation, a concept that still drives banking today. This whole system transformed how people did business, making transactions smoother and way more convenient. Who knew a simple receipt could spark such a revolution in banking, right? Those receipts eventually evolved into the paper currency we all use today. Now you would have an idea of how the banks evolved and so the paper currency. Curious about how modern banks actually make their cash? Let's jump right in. Imagine this. You walk into a bank and drop off $1,000. Easy peasy, right? But here's where it gets really cool. The bank doesn't just stash that cash. It loans out about $900 of it to someone excited to buy a house. This is where the fun begins. That loan not only helps the home buyer, but also gets more money flowing in the economy. And guess what? The borrower deposits that $900 back into the bank, so now there's a total of $1,900 in circulation, way more than what you initially put in. The bank profits from the interest on those loans, making your $1,000 work wonders. Isn't that fascinating? Banks also make money when you invest your money because they take a small percentage of it every time they invest it. For example, if you invest $1,000 and the bank charges you a 1% fee, they make $10 and you only get $990 worth of investment. Banks also make money when you buy products and services from them, like when you overdraft your account or take a loan or a mortgage or buy something on a credit card. All of these things generate revenue for the bank. And now banks are entering into the digital currency space because they want to be able to offer their customers the ability to transact in crypto. But they're not actually mining crypto. Instead, they're facilitating the buying and selling of crypto. And they're making money by taking a small percentage of each transaction. Modern banks are tightly regulated to prevent risky moves that could cause a bank run. They use transaction monitoring, anti-money laundering policies, and strong cybersecurity to keep your money safe. So that's how banks evolved. They facilitate transactions. They charge a small fee for it, and then they use that money to make more money for themselves and for the economy. If you like the video, please like, share, and subscribe to the channel. See video description for important reference links. If you want to dive deeper into the economy, stay tuned.